long-term value for the organization, especially to the shareholders as well as to the other stakeholders. So everybody should win ultimately.
Analyze your contract into this 5-step model. It is easy for you to understand what quantum and how to recognize the revenue, even whatever the complexity of the transaction.
Not pervasive, right? Qualified opinion. If they are pervasive, disclaimer. So both the qualified opinion and disclaimer both are unmodified opinions.
Basically, interest rate option, where if it's the market rate is favorable, you go to the market while you pay your premium. You have to pay.
Way of remembering, I have given numbers. Okay, I have given numbers. So we have subtopics 1, 2, 3, 4, 5, 6, 7, 8, 9 and 10. So we have to discuss 10 subtopics. So you have to remember all these things. And within that subtopic, you are going to get further divisions. So there is an agency relationship between the directors and the shareholders. Or in other words, there is an agency relationship between two parties. You can name the party. Okay, shareholder versus directors, agency principal relationship. Directors versus management, agency principal relationship. Management versus employees, agency principal relationship. Owner appoint auditor, external auditor. Owner appoint the external auditor, principal agent relationship. So corporate governance all about managing this principal agent relationship. Why principal agent? Why? Because always agents are accountable to principal. Agents are accountable to principal. So if you can establish the agent's relationship, you can establish accountability. When you establish accountability, you establish good governance. Environment scanning, you have to identify the choices, then you have to evaluate the choices, and then you have to select the action, right? What you are going to do about CS. So, your actions. So, how you formulate your action is through the process, strategic management process. Like the same way you develop business strategy or a corporate strategy or a functional strategy, you do the same process to develop set of actions as strategies for your CSR. How you are going to be legally compliant, how you are going to be ethical, how you are going to get the profitability of business, that is part of the strategy, business strategy. So likewise, all your action is CSR strategy. Then in other words, if you change the wording, strategic CSR, this is different. Strategic CSR is what? You do CSR, right, as part of your strategy, right, as part of your strategy.
It's a promise to deliver certain goods or services. It may be a good, it may be a service. Now let's look at my contract. I have entered into a contract with my customers to supply 1 million units of marker pens. So what is my performance obligation? Manufacture and supply 1 million units of marker pens. That's my performance obligation. There's only one performance obligation in that contract. But it need not be the same case for all the contracts. There may be contracts with more than one performance obligation. Let's look at this example. So if those three criteria is satisfied, if we know these three, we can simply calculate the present value of future cash flows, present value of future cash flows. So later on, after the end of 2 years, we would have already established the fact that okay, there were no repairs. So as a result, we can increase the lease rental. Right? That is what we talk about here. When the variability of payments is resolved so that they become in substance fixed payments. So there is no variability thereafter. So now we have fixed payments because we know the actual outcome. So based on that, if there is a change in the lease rental, that amendment to the lease rental will be discounted using the original discount rate. So in these three circumstances, if the lease rental is changed due to any of these criteria, if the future lease rental after certain time is changed due to any of these three criteria, so it need not always be the entity's equity instruments. There may be scenarios where another group entity will provide the equity instruments in settlement of these share-based payments. Right? So if you really look at it, the employment contract is between this person and B. But B is not the one who is going to give the issue the equity instruments. A is the one who is going to issue the equity instruments, which is the parent company. Parent company. There is a parent, there is a subsidiary. Or it could be the other way around as well. Right? So, this is something that we need to remember. Share-based payments are not only to be made or settled based on the equity instruments of that particular organization. It may be another related organization's equity instruments as well. Right? So going back to the definition.
Our conclusion, therefore, we need to disclaim not to express any opinion. But on the other hand, if the material misstatements are not pervasive, we can issue a qualified opinion. So this is how we need to form the opinion. So I'm sure, my dear students, now you are very much clear how to form the opinion and how to decide whether it's an unmodified opinion or modified opinion. And in case it's a modified opinion, what sort of modification is needed there. So this is now clear for you. Let's assume a well-designed internal control is not implemented. Can it prevent, detect or correct the material misstatements? No. On the other hand, a worstly designed internal control system, how to implement that? If the design itself is a fault, no chance for a proper implementation, so it's a failure again. So we will name these as inherent risk. When the design of the internal control system is a failure, that risk is called inherent risk. On the other hand, the design is okay, but the operation is a failure, then we will call this as control risk, because the control is there, it was designed well, but it's not operating. Therefore, even the control is there, still the risk is there because the control has not been operated effectively. So, inherent risk and control risk. So, now we have identified some important components: inherent risk, control risk and detection risk. All these connected into the audit risk. These two commonly referred to as material misstatements. So, my dear students, just to wrap up what we have discussed till this moment, audit risk has two important parts: material misstatement, that is a wrong done by the management; detection failure, that is a wrong done by the auditor. As a result of these two, an inappropriate opinion situation emerges. If we further dig this material misstatement into major concerns. The material misstatement is a result of the failure of the internal control system, so that the material misstatements have not been prevented, detected or corrected.
$1,000 after 1 year. So what is the spot rate? Spot rate we have is 3 units of DC for 1 FC. So 1 FC is to 3 DC is our spot rate. Is our spot rate. Right? Is our spot rate. Okay, so we need $100,000 after 3 months. Sorry, after 1 year. So what is the present value of it now? What is the present value of it now? So our interest rate, let's take the foreign currency interest rates, 10%. So interest rate is 10%. So how much will we need now in foreign currency so that we can pay 100,000 after 1 year? Right? So I need to take the present value. I need to take the present value. Option will be better. Right? So it's all about the anticipation, the market context, the volatility of the interest rates. Accordingly, you enter into a relevant agreement to hedge your interest rate risk. So this is about FRAs and options. FRAs and interest rate options. So since the interest rate increased from 3 to 3.25, you have a 0.25 extra interest cost which you have to pay to the bank. So your payment is 1,875 euros. Right. So then what is the gain on futures? Right. So you sell futures at 96.9, then you buy it at 96.65. You buy it at 90. So it's a borrowing. We sell futures initially. We sell futures initially.
Onlineaccounting.lk